Welcome, everybody. I'm Hugh Massie, and I'm looking forward to hosting our next Behavioral Economics Today podcast. And this is something that we've been doing at DNA Behavior for the past year or so. And every time I've done this, I've had excellent guests, interesting people, all going down different paths with decision making. And that's what behavioral economics is all about, and addressing how decisions are made at the intersection of psychology and economics. And in the end, if we can get people to a place of acting differently, relating differently, and deciding better, then we're on a winning path. And no better person for me to have in the conversation today is Ruth King. I've known Ruth for the past 4 years, and we've collaborated on a number of exercises. We think tank things through together, and we both have a deep interest in numbers, helping businesses become more profitable. And we know, I think, Ruth, that it's not just the numbers on the page, it's how people see the numbers as well is extremely important. And, that's been for the past 40 years, helping business owners particularly understand their accounting and create more wealth. And as I think we'll learn about in the podcast today, profits and wealth are something different. And throw in cash flow there as well. That will make it, a very interesting discussion. So welcome.
Thank you. I appreciate you having me, Hugh. Excited to be there.
Yeah, so maybe, Ruth, just to get this started is just to provide a bit of context for the listeners about your business journey and how you got to build Financially Fit Business, which is, up and coming platform that's getting a lot of traction out there with small and medium-sized businesses. So just talk to a little bit more about the journey of that and the passion that's driving you to do this.
So I started as a chemical engineer back in the 80s and had jobs there. And I'm not, I'm a people person, as you probably can see, and I did not do well behind a desk. So I went back to school, got my MBA in finance, and found out that I'm really good with numbers. So I started working with contractors specifically in 1987, doing what Financially Fit Business did with the tools of that time. All right. There was not Excel back then, really. All right. So, we're talking about old tools, but a lot of it was pen and paper, and a lot of it was, graphing. And then the tools started and everything along those lines. And about 5 years ago, we took the Financially Fit Business from paper, well, at that point, Excel and some of the tools, into maintenance or AI driven, so that we don't have to do by hand and by rote what we used to be doing. And what it's done is, it's helped business owners, and it's also helped, amazingly enough, churches, believe it or not, really understand what the numbers are, because most business owners don't get numbers. They see numbers on the page, on a P&L and a balance sheet, and they don't know what they mean. So they throw them in a drawer, and, trying to explain to them doesn't make sense. So we turn them into impactful graphs so that you can easily see the financial health of your business. And the really interesting part, with Hugh, you and I, is that, people will ask different questions, as depending upon their behaviors and depending upon, how they look at the world and economics. And if they're not asking the right questions of what these graphs look like and the numbers look like, they can be headed off into the wrong, way of looking at things, and decisions can be made that are not exactly the way the company needs to do from a financial health perspective. So understanding it from a behavioral standpoint is also really important, so that everybody's comfortable asking the questions, but also looking at the graphs and from their perspective. And we know we all have filters. They're going to look at different people are going to look at the same graphs and go different ways. But in a board situation, they have to be able to talk about it and go through it so that the company makes the best decision possible.
Yeah, just to share a story in there, I can recall the last time that I was on a board, which is 5 years ago or so now. I think it's also part of the reason I'm not on the board, because I walked away from it. But with 13 business owners on this board for this not-for-profit organization, essentially everybody looking at the same set of numbers differently, because they had a different mindset, a different agenda, and a different level of understanding of what it all meant. But what does that do to decision making. And we didn't get any graphics. People couldn't see potential problems or really even understand the questions that maybe some of the others were asking. And some just ignored it and just said, well, okay, this is for the accountants to deal with. And I think that's one situation. And then I've seen with expenses, people looking at expenses, well, okay, somebody's spending too much money on business entertainment and travel, but that's because that's the way they look at the world, but actually had been approved and it was leading to increased revenue, right? So I think optics is really important, and how people, I think where you're going is it's not just what the numbers are, it's how do people interpret them and what's hidden underneath.
Yeah. I mean, I always look at expense and saying, okay, how much revenue has to be generated for this particular expense? And you gave the travel expense piece of it, but I had a client years ago who his partner was complaining about the fact that he went and played golf, I think once or twice a week, but the partner who played golf always came back with a contract. And so it was like, why are you complaining? I don't get it. That type of thing. And, I look at it because I started a nonprofit in Atlanta in 1985, 6 with 2 other people. And one of the things I made sure was every board member, I gave all right, this is what a P&L is. This is what a balance sheet is. This is what you need to look for. And back then we didn't have all the tools we have now, but I taught them so that they could at least ask basic questions and make sure that we were headed in the right direction from their perspective. It's important. It's really important.
Yeah, it's interesting that we're sitting here 40 years later and the problem only are getting addressed now. And do you think that's because AI is allowing us to address that problem?
No, I think we now have the tools to be able to, and they don't have to be AI tools. They have to be the tools that just allow them to really see things like they need to be seen, i.e. graphically. I mean, I didn't even think about graphs back then. I didn't think about trailing numbers. I didn't think about trends. And I don't think anybody did at that point. And I'm being totally frank about that. I mean, it just wasn't in the vernacular of what we did from a financial standpoint. It was always P&L, balance sheet. You either made money, didn't make money, gross margins, and all the other fun stuff like that, not the impact of the gross margin. I think that came later rather than, okay, here are the numbers, the impact of the numbers. And that's what started the whole thing, because once we can have the tools to show the impact of the numbers, that's when everybody starts really and truly understanding what's going on and can make the right questions, ask the right questions from their perspective.
And do you think that people actually understand? I mean, you've mentioned gross margin, but do you think people really understand what gross margin is versus the net profit margin? Because they're pretty important concepts.
Yeah, absolutely. So I got really tired of explaining it. So I wrote a book called The Courage to Be Profitable, and explains it in English. So it's, you can buy it on Amazon for $10, but it explains everything. And that's why I think that any board, any CEO, any vice president of any company needs to have some sort of basic financial literacy. And I mean business financial literacy. I don't mean financial literacy from the standpoint of, how to invest or, that type of thing. What is the P&L? What is the gross margin? What is the net profit margin? What is overhead? What is direct costs? What's a liquidity ratio from a balance sheet? Most importantly, what is working capital and why do you have to watch it? And all of these concepts, we think about it, they're pretty easy to understand. I mean, all of us, I assume on this, listening to and watching this podcast, have learned to drive. I'm making that assumption, okay? The first time you got in a car, you didn't know what you were doing. You had to pay attention to 27,000 different things, and it was hard. But now it becomes reflexive. I mean, you get in the car and you don't think about what you do, and our minds wander now, and that's when we start getting into crashes. Is when we stop paying attention. And it's the same thing from a P&L and a balance sheet standpoint. In the beginning, it's a little bit confusing, it's a little bit hard, but then we did it to drive because we wanted the freedom. Well, guess what? Spend 10 minutes a month doing it. And then it becomes reflexive. And this is where I think owners and businesses get into trouble, is when it does become reflexive. They think, okay, everything's cool, everything's fine, and they stop paying attention. And that's what boards are all about. That's what business ownership, and that's what managers should be doing, from your perspective, and looking at it from a behavioral standpoint, going, okay, we can't get complacent about this. and it will take, different personality styles and different behaviors and different ways of looking at the world to make sure that it doesn't happen.
Yeah, I think it's very easy for a business owner to be complacent about the numbers, particularly if they're a salesperson or an idea orientated person. They're an innovator, they've created something, they've learned how to sell it, and they're off racing about out there and think that the accountants have got it in order or their COO. And I'm not just talking about theft, but just in properly understanding it and what does the cost structure
Yeah,
mean.
I'll give you an example of one of the financially fit business users. They're about a $15 million company, so they're not, huge, huge, huge. And they were doing really, really, really well. And we actually started seeing the degradation because they stopped paying attention. When suppliers increased their prices, they didn't always raise their rates. When productivity got lower, they didn't always figure out why. Until they finally hit their gross margin just about equaling their overhead, which means the profits were getting to zero. And then, oh my gosh, they started paying attention again and it went right back up. So complacency can be eliminated if there is structure. Review every single day, every single month, every single week, you do specific things. And it's not hard, it doesn't take long. And once you start doing it, it makes it a lot easier.
So in a sense that putting the structure in there is a process, and it's then about empowering that CEO owner to take a look and to take responsibility, because that is what they're responsible for, to
Mhm.
provide a return to shareholders. Even if they are the shareholder, they've got a responsibility.
To themselves, at least.
Yes, to themselves, and I think to the employees and to to the stakeholders, to do the best they can to be to make it sustainable. But so tie that, Ruth, into the financially fit platform and taking the accounting information and making it more visual, how that helps with all of this.
All right. So essentially, depending upon what software package you used, we have API integration with several of them right now. And for those that we have totally integrated with already, and every couple of weeks we integrate with another package. So I don't want to say we're only this, this, and this. By the time this gets aired, it'll be maybe 6 more, And so all you do is you put in the date range of the numbers that you want. Let's say we finished, this is August, almost August, and, we finished July's numbers. So you put in July 1, 2026, July 31st, 2026, it automatically does the graphs. AI reads it, makes sure that it follows all the rules and there's nothing blaring that's wrong with it. And then you look at the graphs and see what the trends of your company are. And does it take a little bit of time to learn the graphs? Sure. It's like learning to drive. It's not hard. Just do it. And then you review them every month. The CFO can prepare it, make the presentation to the COO and the rest of the management team and the executive team, and they all go through it and understand what's going on. This is me personally, I never totally trust a CFO. I've seen too many of them steal over the years, but that's, from my perspective and where I'm coming from. The ultimate thing, there was the CFO from a construction company in Chicago who stole millions because the owners weren't paying attention. And he finally got into his orange jumpsuit last summer. He went to jail. So, I know I'm probably taking this down a different path, but the financially fit business system is literally 14 graphs that show you the P&L health of your company, the balance sheet health of your company, and are you heading in the right direction or not? And it will show you little things, and you take care of the little things before they become major crises. It's that easy.
And is it the same 14 graphs for every business, or do they get customized depending on what your business is? I know you deal with a lot of contractor businesses.
Yeah, doesn't matter. A P&L is a P&L, a balance sheet's a balance sheet.
But are they different? Are they different graphs that it's all the same for everybody? They're attacking, the fundamental issues.
Yeah, everybody needs to look at an overall P&L graph, which looks at revenue, looks at gross profit, looks at overhead and net operating profit. Everybody also has to look at gross margin graphs, i.e. gross profit divided by sales, and make sure that the margins are going the right way. You also have to look at productivity graphs. It does not matter what businesses they are. What may matter, especially with the productivity graph, some very high service oriented businesses that don't do any products, their productivity ratio is going to be probably 50, 60% because it's only people. But somebody who's a manufacturing company, their productivity ratio is probably about 15, 20%. So those change. The net profit per unit of revenue changes also depending upon where, what type of business you're in. But the overall graphs, they're there. What they should look like may change by industry in terms of where the number should lie. But the overall graphs, accounting hasn't changed for over 1,000 years.
No, it hasn't. And I'll come back to a point you made a second ago, but in looking at the 14 graphs, then does the CEO and say the CFO, the C-suite and the board need to have a common understanding of how you look at those graphs so that the key, if you want to call it the key number in the business, or numbers, I like to think that there's often one number that if you really focus on that, it drives a lot of things. That's understood. So there's a little bit of training for them that they can either do on their own or they come to you and get that so that they
Yeah.
are
I've
all
done a
looking at
bunch
the
of
same
board
thing.
presentations. Yeah.
Yeah.
And training them, and just to make sure everybody understands it. The one thing that matters the most, it doesn't matter, where you are, is net profit per unit of revenue. And we track that. So what that means is, how do you actually generate revenue? You think about it, a car wash generates revenues by the number of cars that go through the car wash. A CPA firm generates revenue with billable hours. And, how much for every billable hour drops to the bottom line. And it does not matter what industry you're in, there is a way you generate revenue. And that's the key indicator of what you have to watch every single.
And so that's really where, you come back to there being a fraud or a theft or something like that that's gone on in the business. But if you're the CEO, for example, or the owner or set of owners, you would probably identify that through the graphs that
Yes, you do.
something's wrong because you would expect that if the business is earning 15 million a year, you would be attuned to the fact that, say, the gross margin's 60% and the net profit margin's 30%. And when it veers off that path, you're going to know something's up, or in a particular area, something's being buried by somebody. It sort of it starts to stand out.
It's like the graphs are going the right way. They're trending upward where they're supposed to be trending upward. And all of a sudden you see spreads of things that shouldn't be spreading.
Yeah.
It's like, all right, time out here. What's going on?
So at least, even if you're not as financially intelligent or literate as maybe somebody else, you could look at the trend and learn to ask a deep question, and that would be important. So that sort of deals with the negative side and perhaps the fraud side, but there's also the other side here that I think is important, that if you are going to make a structural decision for your business about growth, or, a distribution arrangement or a sales arrangement, because I think that a lot of time people make sales arrangements without understanding profits.
And cost. Yeah, I agree.
And the costs, this would help you make the right decision because you're interpreting the information the right way.
Yeah. It makes it very, very easy. And I can tell you stories of theft that we found just by, small changes in gross margin and things along those lines. It's just the trends actually show you what's going on. And when the trends even a little bit go off the rails before it becomes a major crisis, figure out what's going on. And that's really the key for all of it. I can't tell you how many business owners tell me now, I never want to look at my numbers again. As long as my graphs are going the right way, I won't look at numbers.
Well, I know this is going to sound, and I'll move the conversation along, but I think this is important. I know that when I first came to Atlanta, I was a shareholder in another company in the area I'm in human behavior, and all my career and sort of investment life. And I was still pretty young at that time, 35 when I did this deal to come into this company. But I was always strict about, I need to see the accounts every month, et cetera, because I'm an accountant by training. But, I was at a stage of life for whatever reason where I just thought, okay, these guys are telling me that they're good Christian business people, et cetera. And I just let it all go out of my passion for what I was doing and what I thought they were doing. And then there would be these odd conversations and the bells started ringing off. And so the moment I asked a question, it all came out. And when I then did a little nighttime review with all the information, why has a company got a very big expense sitting in training when it doesn't employ any trainers, right?
Lovely.
And it's only got to be one thing. And then that is actually what it unraveled, though. And I think this is good for people to understand, is a whole sequence of other stuff.
Mm-hmm.
because once it's wrong in one area, it's usually wrong in other areas. And
it's a snowball effect.
It's a snowball effect. And maybe and I think that's good for everyone to understand that there are often other motivations that lead to things like that. But you are bringing up a really good, what the real point is while that person, in my case, and he was the CEO responsible for doing that, right? And it was wrong, right? At all levels. I was wrong. And so was the other business partner in it for not holding him accountable. And I was perhaps the more accounting attuned. And so the 2 times or 3 times in my whole career that I have not held someone in that kind of role accountable, there's always been a problem every time. And that was including in the other not-for-profit I walked away from. So it's like this stuff happens. But I think something I want to bring up, I just want to mention here, Ruth, is that we're just assume the world is normal, right? There isn't fraud, but the CEO and the key team not fully understanding, and that could be the CFO too, not understanding the proper dynamics of the business. And now we're making a high stakes decision to buy another business or to expand or do something that if you've misunderstood the financial information and you make a key decision on that, it can lead to what I call the decision cascade syndrome of one bad decision on another bad decision.
And then we keep going. Yeah.
And you keep going until there's nothing left. And I think that's a trap for a lot of entrepreneurs who are very ambitious and want to grow, right? But not really knowing what that growth means and the implications of it.
Yeah. And understanding the cash needs for the growth and understanding, what happens as a result of growth. If it is a solo, an entrepreneur who's doing it and who's totally responsible for everything, that's one thing. If there is a management team in place, which generally there is, especially with high growth companies, it is the entire management team responsibility to review financials every single month. And, from your perspective, it's like, okay, I look at the world this way and I'm going to look at the financials this way and I'm going to ask questions based on this. And, over here, we have somebody who looks at the world totally different, communicates totally different. And the two of them should have the comfort, I don't know any other way to describe it, of being able to have an honest discussion about it rather than fear of bringing something up.
Yeah. You should be able to ask questions. And that's, what I call psychological safety in the relationship without recrimination. And so do you feel that that having a more visual explanation of the numbers levels the playing pitch to allow that to happen? It's easier for people to get in there to ask a question. Well, the graph says this. Is that, psychologically how you...
That's an easier psychological path because there's something visual that they can see. It's not a number that they may or may not understand. It is, okay, this is what's going on. These are the graphs, and either they're headed the right way or they're not. But I think it's also the responsibility of the CEO or whoever's the chairman of the board to make it a safe environment for the questions to be asked.
Yeah. And I think that's where I see the role of the chairman also, who should have some knowledge in this area. I just think that's safer for a governance perspective to ensure that all board members are trained to look at these numbers. This is what they should be. If we're hitting our target of 15 million of gross revenue, whatever the number is, you just use that number in a previous example, but I think it's a good sort of level for this. This is what we would expect to be happening, and to mine in there. Whereas if you just show, okay, here's the receivables number and here's a debtors number, people don't get it.
No, they don't. And and the thing is that I just did a podcast webinar, where we look at one graph we look at is receivable days, which just very easily from the time you send out an invoice to the time you get paid, how many days is it? It's that simple. So I watched the receivable days going from about 40, which was normal for them, and then it went 40, 50, 60, and we have this big peak at 100. And I'm going, what's going on? Well, we're so busy we don't have time to collect. We're billing, but we don't have time to collect. So they hit 100 receivable days, which is 100 days after they send out an invoice. On average, they got paid. They had over $1 million in receivables and no money in the bank to pay their bills. It was their wake up call finally, and it went back down to normal once they started paying attention. So, sometimes the board and the owners have to get hit between the eyes with a 2x4 before they're going to pay attention.
But that complacency or just ignoring and saying we're too busy to do it can lead to, I think, massive problems. One,
What did?
because it can lead to then the customers not wanting to pay if they're not being followed up on. The negotiations start to happen, and then you lose quite a lot, not just the time value of money of not getting the receivable. There's negotiations going on, and you don't know that there aren't problems with the work that's been done as well. And then, of course, there's the fraud part of it of, well, has some of this been paid to another place, right?
Yeah.
So there's lots
I,
of angles. That's why that's a very unhealthy place to get to with it. So, I suppose when we're dealing with, these business owners, do you think it's just, and the CEOs, do you think it's just complacency, Ruth,
I'm
that's
not
the
sure it's
problem?
complacency. I think it's they are so focused on what they do well. And a lot of them are so focused on growing the top line, they forget it's not the revenue line. It's what you keep it's important to have the revenue, don't get me wrong, but it's what you keep that's what's mattered. But I know you're Australian, but at least in the US, it's always been grow, 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 top line, top line, top line. Nobody talks about bottom line. And it's not growing the top line that is critical. It's growing your bottom line that's critical. And so I think a lot of the mentality, especially with business owners I'm going to grow this exponentially, then I'm going to sell it. How many owners are like that? And they forget that it's not the top line that they're selling their business on, it's the bottom line. And if their bottom line is no good, they're not going to get a whole lot for that business, even if their top line is, $20 million.
Well, I think that's one of the problems because of so much VC and PE money in a lot of businesses and roll-ups and everything being done. And it doesn't take a lot for someone to realize, well, gee, my friend down the street built a business from 1 to 5 million and suddenly he's exited it on a multiple and no profits. It's just been growth. But in a way, it's been a bit lucky. You've ridden a trend. And if times get bad or harder, or there's a blip somewhere and you do need to exit or raise capital and you're not profitable, it can become problematic.
It's very hard. Yeah, it's very hard. And the friend who got, that big multiple didn't tell him what his profits were, just told him what his revenues were.
Yeah. And I've been around, Entrepreneurs Organization for 25 years with lots of businesses at different sizes. And I could tell you that there are businesses in there north of 100 million, Ruth, that are not profitable, or they're making certainly under $1 million profit. And then you've got a business at 5 million making $1 million of profit. What's the better one, right?
I'd rather be the 5 making $1 million.
Yeah. Or there's a guy I know at the golf club, that's CEO of a $4 billion turnover business, and everybody thinks it's fantastic, but it doesn't even make 40 million as far as reported profits.
Yeah.
And I'm thinking, now, $100 million business at a 60% margin is better than that. But BC, I think this gets back to the point of how a number's being interpreted.
And what questions they're asking and how they're looking at the numbers and their viewpoints of looking at the numbers and their belief systems. That's all about what you do. Making sure that there's congruency on the board with belief systems and making sure that everybody is, focused in the right direction and making decisions that are not, based on their own personal biases.
Yeah. And I think that even when I was a tax advisor, and I've gone back to this a lot, that, you can write out the 50-page letter of advice, and has it really been understood? And that when it's reduced to diagrams, and that's what I was doing in the late 1980s and early 1990s, was like you were, in a way, there was a common path there, like what you were doing with really helping businesses become financially fit once you worked out that you were good with numbers. Mm-hmm. When I realized I was pretty good at tax and good at the accounting side of tax, not just the interpreting the law, I realized, though, that if people didn't understand what you'd written, they'd make the wrong decision. Mm-hmm. Or they wouldn't pay your bill, right? And both were a problem.
Question it, whatever, yeah.
Yeah, and so I think that's why I keep bringing up here that the importance of the graphics is to be able to create a psychologically safe environment for people to talk about what the numbers are and what the truths might be, to ask better questions. I think that's something's important here, but to uncover what might be something lurking below the surface that wouldn't be the normal thing people would think of when they just looked at a sheet of numbers, right?
Yeah. Well, it's funny because I teach a lot of I teach classes for CPAs on, the little things mean a lot, and they're CPE approved and everything along those lines. And they come out of those classes with open eyes because they don't learn this in school. Even if they have took a class in finance or whatever else it is when they were going for their accounting degrees, it's like, okay, the numbers, the debits and credits have to be accurate and clean and all that sort of fun stuff. But what happens with the debits and credits is what's really critical for a business owner to make sure they're headed in the right direction. And that's all graphs. That's all pictures because they don't get numbers for the most part. I'm not saying the CPAs don't get numbers. I'm saying business owners don't get numbers. They're not focused on it.
Yeah, they're not. And I think it's then getting the right numbers and interpreting the right way, isn't it? And I think that people think it's not their role. And that's,
It is. If any business owner, it's their responsibility. They can delegate the responsibility, but they can't delegate the authority. If you want the day-to-day stuff done and you want the reports created by your CFO or a bookkeeper or something like that, fine. The business is still yours. You can't abdicate responsibility for the financial side of your business. And now I'm getting on my horse. I'm sorry.
yeah, no, that's okay. So let's say that the graphs from Financially Fit bring out that there's a problem. Why don't the business owners or the board necessarily act on the problem?
Good question. It's probably because they don't perceive it as serious enough at that particular point. I give you the example of 100 receivable days. I mean, he had to get hit between the eyes with a 2x4. Sometimes it just is such, okay, I'm more busy. I'm busier doing these other things. I don't have time to do this, whatever else it is, until sometimes you just have to get hit between the eyes with a 2x4 before you start paying attention. And I promise you, once that happens, it never happens again. But sometimes it's just to the point of, okay, let it go for now. Or somebody has stolen $500,000 of copper from you. I mean, a little bit at a time.
Yeah, and is it just that people don't have the resolve to go and deal with it, or they are, just as you said before, so focused on the growth? We won't worry about that for now and leave it for later, but that's sort of that decision cascade syndrome, then it just builds up.
Right. And then they get hit between the eyes with 2x4 and have to pay attention, where they could have solved it 5 months ago. That's when they learn the lessons. That's when I think business owners really learn the lessons and really learn to start paying attention to what's going on the financial side of their company. When a big customer doesn't pay and they needed that for payroll, I'm talking about smaller businesses here. When a CFO steals $10 million from you or something along those lines, then they put the processes and procedures in place. It's like, if they'd done it before, this wouldn't have happened, but they had to get the experience. And I'm saying the negative experience, not the positive experience, so that they paid attention to the little things. They can still do their stuff that they do. I mean, this is not a big deal in terms of taking huge amounts of time. Just do it.
And do you think that it's that people just wait, right till their death on this because they don't want the conflict of it, to have to look in there and potentially make a structural decision that could fundamentally change the course of your business? Because there's something there until people are forced into a corner and their mortality is almost on the line. They won't do what's good for them.
And sometimes it's disbelief. Like, I don't believe this person could do this, or I don't believe, that they could do this. How can they do this to me? I mean, that's another thing that happens is like, or it will reverse itself next month or something along those lines. And when it doesn't, then you're in a situation, okay, what is really going on here? And it really hurts if it's a situation where, people are stealing or something along those lines, or, the productivity's gone down because nobody's paying attention. And it just hurts that the managers aren't doing their jobs. And sometimes you're right. They don't want to confront the issues. It's not their personality styles to like confrontation. And you know that better than I do. Communication is hard. And, it's not like, this is what we expect. I had this conversation yesterday. I will not say who, what, when, where, why, or how, but they've built this phenomenally great company, but they've also put up with a lot of stuff. I said, you can be, and you should be, and take care of your customers and take care of your employees and care about them, but care about them profitably. If they're in a position where they're not producing profits for you, as much as they're friendly or nice or whatever, and you want to be nice to them and no 27,000 excuses, they're not profitable for you, then it's time to either put them in a different position if they can, or it's time to figure out what their exit plan is.
Yeah. Yeah. And That's right. And that you can't have that person as an emotional drain on you, worrying about whether they are doing the right things or adding value or not. It's not usually about the person being a good person either. It's just, are they a fit and what's the drag of that? But do you think, and I know this, I'm probably throwing this question at you and then I'll sort of get to a behavioral question, but in people looking forward, so using the graphs and saying, okay, our numbers are portraying X right now, but in this world of AI where the world is changing fast,
Mm-hmm.
Whatever business you're in, it's changing it in some way. Do you think that the owners, the boards, the key executives of companies could do a better job at forecasting what they need to do in the future and how a particular trend, if it really takes hold, might impact them? Because it's going to affect the key number in a good way or a bad way.
I have seen ChatGPT and Claude and Gemini give the wrong answer so many times and people believe it and it hurts them worse. Get somebody who's a body, a person who truly understands this and give it to them. I had a bookkeeper throw their numbers into ChatGPT and ChatGPT said, basically, you're going bankrupt. She went to everybody and said, ChatGPT says we're going out of business, go find another job, rather than asking, somebody who knew what they were doing.
But if financially fit's set up in the business and you as the CEO, chairman, CEO, CFO, and other key executives know what the numbers should be, and then you map that against the particular trends that are going on, surely you could make a better decision.
Yes.
Or now it says, well, yeah, we need to come up with a new product, but we should only invest in X in that product to keep our margin. Or we need to cut out the private aeroplanes and whatnot. That's another whole area we could get on a hobby horse. But because we're talking about value creation there. But I think this could be used for simulation by getting people to concentrate on the right number.
Yeah, it can be once you know the trends. Yeah.
So what about just sort of general different personality styles that you see there in how they deal with numbers? For example, Ruth, I was thinking about this and, people that are very, what I call planned and structured, they're into budgeting.
The CPA types.
Yeah. And again, not all CPAs are actually that way, because some CPAs are good at sales and they're not as good with the numbers. But generally speaking,
Leon.
it's paralysis by analysis.
By analysis, yes, we can do that.
But do you?
Yeah, the way, I don't know whether it's a behavioral thing. All the different behavioral styles look at the numbers slightly different because of where they are. It really and truly is a procedural thing. Do it. You'll look at it one way, somebody will look at it another way. And, if we have the 4 different DISC styles or, your behavioral styles, they'll come up with a really, really good answer to it because they're all looking at it in a very different way. And that's the key. Take the numbers, take the graphs, see where the graphs are going, and then everybody asks the questions and make the right decisions based on that. And that's what I would do with it.
And I think that's what I was bringing out was, if you take the same set of numbers, someone that's very planned, structured, analytical, however you want to, whatever behavioral system, whether it's the DNA system or DISC or whatever that you want to reference it to, I always find that, not only are they slower to make decisions, which can be a good thing, but they worry about whether there's enough money, that they're going to over-reserve and not free up the company to expand. Then you get others that are just very cautious. That can be a different thing to the over-reserving. They're just cautious about, well, what could go wrong? And then you get the optimistic type people that think, well, money's just going to keep coming in and we'll solve that problem when it comes to it, right? But that's how people are can be looking at the accounting, and if not brought to the table with common set of graphics and understanding of what to look for, all of that will go on.
Yeah, agreed. Yeah, that's why the graphs work. They don't lie. As long as the numbers are accurate, the graphs don't lie.
So just for us to sort of start wrapping up, Ruth, because we've talked a lot about, I think the numbers, visualization, that human behavior is a key element here. That's why I call myself a reformed accountant a lot of the time. But your point about profit versus wealth and that they're different things.
Yeah, they are very different. Profit is how much revenue minus expense. Did we have, if profit, if it's a positive number, we had more revenue than we had expense. It's a negative number, we had more expense than revenue. Cash is a wealth number.
Yeah.
Cash
Okay.
is,
That's where all right. Great. So keep going on that.
so if you look at a balance sheet, which is where most business owners don't get it, but it's more important than your P&L. A balance sheet will actually tell you true profitability, because if you have profit, your wealth grows. All right. Now that's assuming you don't do something stupid with the numbers, and that type of thing. But I'm making assumptions here that from there. But basically, a balance sheet tells you how profitable you truly are, whether your profitability is increasing or decreasing. It tells you whether you can pay your bills easier or harder, whether you're carrying, getting too much debt, what your receivable days actually look like, what your inventory days actually look like, what your working capital actually looks like. Is the health of your company getting better or worse? And that's really where we start and where you should start is there. I mean, P&Ls everybody kind of gets, and then they look at balance sheet and say, I don't get this. But once they understand that your balance sheet actually shows you true profitability, and if your balance sheet's going the wrong way, that's your first indication that your profitability is decreasing.
But we're also saying that just looking at a profit number doesn't necessarily mean there's wealth creation there.
That's
because
correct.
there's a lot of problems inside how profits are calculated.
Yeah. Well, not only that, the profits have to turn into cash and
Right.
get paid.
So really it's about cash at the end of the day.
It's about cash flow, positive cash flow.
Because I can remember many years ago having dinner with a gentleman who was an accountant, and he was giving me some mentoring, and I was about 29 years old, looking at what I would go and do with my future, because I decided that I wasn't going to be working in Arthur Andersen anymore. And he was giving me a lot of mentoring. We'd sit there after the first bottle of red wine, and Anthony would just say to me, Hugh, what's more important, profit or cash?
Cash.
Yeah. And I knew that answer, and I'd just say it, and he just kept looking at me, and then it's basically another glass of red wine would go down, and he'd ask me again. What he was really doing was sort of in his weird way was really testing me whether I understood and whether I was just giving an answer for the sake of it. But we would basically talk all night about that subject, that it was, and people talk about cash is king. But we've got to really understand, how does that
profitable cash is king?
Yes. How does that profit? Is it leading to?
All right. You got to have profits to have positive cash flow.
Yes, because you could have profits, but you don't have any financial flexibility inside there with the cash.
Or you can have cash, and you, for every dollar you take in the door, you're losing 5 cents. And after a while, that will kill you. You still have cash flow, but it's got to be positive.
Or you've got some liability hanging around that could be called on you. That's a problem. And so understanding the real truth.
Yeah.
Is,
and you get to see that in all these graphs.
Yeah.
So,
yeah.
Cool.
So Ruth, is there any other wisdom that you would like to give business owners, as in terms of how they should be making decisions, the pitfalls?
Yeah. What I would say is financials are not hard. They just take a little bit of time to understand, and think back to the driving example we talked about earlier. But once you understand your numbers, they can become fun. I know for a lot of you, they're not fun right now because you don't get them. But the graphs help a great deal to be able to make that happen. And once you start understanding numbers, you can take care of the issues before they become crises and build wealth. And that's the bottom line.
So in a way, one of the things I take away from just what you just said there in wrapping that up is what Financially Fit is doing is making the numbers fun.
Yeah, that's what we do. That's exactly what we do.
That in a lot of ways could be seen as opposites, but I think people need to see this as fun. They need to see it as easy.
And we've done both.
Yeah, and it's the key to your future.
Yeah.
Well, Ruth, it's been great spending time with you today.
Likewise. Thank you so much.
To bring to life Financially Fit. And for anybody, please go to financiallyfit.business and have a look. But, Ruth really is an expert in this. You've got getting 40 plus years of experience, war stories, as you could hear today.
Oh my gosh.
Coming out. And I think it is in the end helping people simplify their understanding of accounting, make it fun. And really a big message is make it an engaging conversation in your business.
Thank you, Hugh. I appreciate it.